You take a trade on a strong stock. Your entry is good. The setup is clean, but within minutes, normal price fluctuation hits your stop loss. Then the stock continues without you. The problem was not your direction. The problem was your stop placement. Today, we are going to talk about ATR, the average true range, and why it may be the most underrated risk management tool in the US stock market. This is a technical masterclass on volatility. You will learn the mathematics behind the range, the legacy of J. Wells Wilder Jr., and the exact frameworks for stop-loss placement and position sizing. By the end of this video, you will move from guessing your stops to calculating them with mathematical certainty. Survival in this market is about managing the noise. To master ATR, we must look back at its genesis. Average true range was developed by J. Wells Wilder Jr. and introduced in his landmark 1978 book, New Concepts in Technical Trading Systems. Wilder was a mechanical engineer who brought mathematical rigor to the financial markets. While he also invented the RSI and the ADX, ATR was designed to solve a specific problem in the commodities markets: gaps and limit moves. A simple high-to-low range doesn't capture the full extent of market energy when prices gap overnight. Wilder's engineering background led him to create a true range that accounts for these gaps, providing a complete picture of market velocity. This legacy of precision is what we use today to stabilize our trading in the high-volatility environment of the NASDAQ and the New York Stock Exchange. ATR does not predict direction, it measures the degree of movement. To understand it, we must deconstruct the true range. Wilder defined the true range as the greatest of three specific values. First, the current high minus the current low. Second, the absolute value of the current high minus the previous close, which captures a gap up. And third, the absolute value of the current low minus the previous close, which captures a gap down. By taking the maximum of these three, we get the true volatility of the period. Average true range is simply a smoothed moving average of these values, typically over 14 periods. If a US stock has an ATR of $2 on the daily chart, it means that, on average, it moves $2 from extreme to extreme every single day. This number is the heartbeat of your risk management. It is vital to distinguish between volatility and direction. ATR tells you how much a stock moves, not where it is going. A high ATR signifies large price swings, often seen at market bottoms during panic or in powerful breakouts. A low ATR indicates consolidation and stable prices. Beginners often fail because they ignore this data. If you place a stop loss 50 cents away on a stock that typically moves $2 per day, you aren't being tight with your risk. You are being mathematically illiterate. You are almost guaranteed to be stopped out by normal market noise. Professional trading requires you to give the stock enough room to breathe based on its current ATR. You must adapt your stops to the market's pulse, not your own fear. Now let's break down the most common professional application: stop-loss placement. Instead of placing random stops below candles, we use ATR multiples. A standard professional method is placing the stop-loss at 1.5 or 2 times the ATR away from your entry. For example, if you enter a long trade on a 5-minute chart and the current ATR is 40 cents, then a 1.5 multiple equals 60 cents. Your stop would be placed exactly 60 cents below your entry price. This multiplier ensures that your stop is outside the zone of normal price fluctuation. It forces the market to prove you are wrong by making an abnormal move against you. This protocol alone can transform a choppy equity curve into a consistent one by reducing premature exits. The second pillar of ATR mastery is position sizing. Standardizing your risk across different stocks is impossible without volatility data. If you always trade 500 shares, you are taking much higher risk on a volatile tech stock than on a stable utility stock. ATR solves this. By using your ATR-based stop distance to calculate your share count, you normalize your risk. If you risk $100 per trade and your ATR stop is 50 cents away, you take 200 shares. If the ATR doubles and your stop is now $1 away, you automatically scale back to 100 shares. This ensures that no single trade can disproportionately damage your account. You are letting the market's volatility dictate your size, ensuring survival through every environment. We can also use ATR context to time our entries. One advanced method is the volatility expansion breakout. Step 1. Identify a period of low declining ATR. This indicates a squeeze or market compression. Step 2. Wait for price to break a key structural level. If that breakout is accompanied by a rising ATR line, it suggests strong institutional participation and the beginning of a new trend expansion. The rising ATR confirms the velocity behind the break. In contrast, a breakout on flat or falling ATR is often a fakeout. By using ATR as a filter for your breakouts, you ensure you are only entering when the engine of the market is actually turning on. Trade the expansion, ignore the noise. To capture the meat of a major trend, we use ATR trailing stops, often called chandelier exits. As the price moves in your favor, you trail your stop at a multiple, typically 2 or 3 times the ATR, below the highest price reached since entry. This creates a dynamic floor that follows the trend. In a volatile US stock, this allows you to stay in the move through minor pullbacks that would hit a static stop. You only exit when the price makes a significant, abnormal move against the trend. This is how professional swing traders catch 20 or 30% moves on NASDAQ leaders, while retail traders are constantly shaking themselves out for small gains. Let the ATR be your guide for when to stay and when to walk away. Mastering ATR also means recognizing the exhaustion spike. When ATR suddenly spikes to an extreme vertical level, it often signals a volatility climax or panic move. In these moments, the move is likely overextended. High ATR environments at the end of a long move suggest that the energy is being spent too quickly. Instead of entering late due to FOMO, a professional looks for volatility to contract afterward. Understanding this prevents you from buying the top of a parabolic move. If the ATR is at its 52-week high, the statistical stretch is at its limit. This is the moment to harvest profits and wait for a reset. Respect the climax, and you will avoid the crash. On highly liquid US stocks like Apple, Microsoft, or the S&P 500 ETF, ATR behaves much more predictably. Institutional volume smooths out the true range, making your stop-loss calculations much more reliable. On thin, small-cap stocks, a single large order can cause an ATR spike that doesn't reflect a trend change, leading to constant false stops. For beginners, we strongly recommend focusing your ATR analysis on large-cap leaders where volume stabilizes price movement. The higher the liquidity, the more reliable the math becomes. You want to trade where the big money moves, as their institutional flows respect these mathematical boundaries. Professionalism is about choosing the right playground. Let's look at the impact on your win rate. Combining a basic trend strategy with ATR-based stops and position sizing typically produces an effective win rate between 55 and 60% on liquid US stocks. But more importantly, it creates a much more stable equity curve. The key benefit of ATR is not a massive jump in win rate. It is the dramatic reduction in emotional decision-making. You no longer guess where to place stops or how many shares to buy. You base every decision on objective, real-time volatility data. This consistency is what allows you to trade through losing streaks without losing your discipline. Stability is the foundation of long-term profitability. ATR is the engine of that stability. To summarize, ATR is a powerful framework for managing survival. It does not tell you where the price is going. It tells you how violently it can move. And in the professional world, knowing the move's potential is just as important as knowing its direction. Spend the next week just observing ATR levels on your favorite stocks. Look for the compression zones and calculate your 1.5 multiple stops. Once you stop fighting the market's natural noise, you will have a professional edge that few retail traders ever achieve. Remember, risk management determines your survival, and survival determines your profit. Start practicing today and protect your capital with math. I'll see you in the next lesson. Good luck out there.